Welcome to this month's market update, the show where I talk about what's been driving investment markets and what to look out for in the days and weeks ahead. Now, if you find any of this video useful, then please, if you're watching on YouTube, make sure you hit that like button and you subscribe to the show. If you're listening to it on the podcast app that you choose, then please also make sure you subscribe to our show and you make sure you catch our Sunday Money to the Masses podcast show. So moving on to the show, well, last month's market update, we were left pondering whether the Santa Claus rally would turn up or not. And in fact, the title of that show was Santa Rally or the 2018 Grinch. And as it turned out, 2022 was one of those rare occasions when the Santa Rally didn't arrive. Now, if you're looking at December as a whole, that is the case. But if you use the strictest definition of a Santa Rally, which covers the last 5 trading days of 2022 and the first 2 of 2023, then the Santa Rally did technically arrive. It feels a bit of an odd one, a bit like when the Met Office announces that 2022 was technically a white Christmas in the UK because 5 weather stations across Scotland and Northern Ireland actually recorded sleet or snowfall on the Christmas day. For the rest of us, it didn't feel like a white Christmas. And it's a bit like that with the Santa Rally. In any event, the technical Santa Rally did produce a return of approximately 1% over the 7 days that I mentioned. And that is still technically significantly higher than the historical returns of other 7-day periods during the year. But put it into the wider context of December's equity market moves and those of 2022 as a whole, then it was hardly a cause for celebration. Now, looking at December, the global stock markets, as measured by the MSCI All Country World Index, fell by 4.85% for the month. But there were significant geographical variances. So if you look at the MSCI Asia ex-Japan index, for example, that was one of the best performing main stock market indices. It still fell, but it was only by 1.08% during December. Alongside that, the FTSE 100 returned 1.6%. And then we had the MSCI Emerging Market Index, which fell 2.23%, followed by European equities, which fell 3.6%. And that's if you look at the FTSE Euro First 300. If you go to US equities, they were among the worst performers during December, with the S&P 500 falling 5.9% and the Nasdaq 100 fell an eye-watering 9% in a single month. And much of that divergence in fortunes occurred during the last 2 weeks of December, when Asian, emerging market, UK, European and value stocks outperformed their US peers. And it ultimately meant that December 2022 resembled 2018, and that potential parallel that I drew in last month's show actually did come to fruition. In terms of the whole of 2022, it will be put down as a disaster for most investors, be they professional or armchair investors, and I won't go into the full details of the performance of various assets and stock markets during the year, but the top performing unit trust sector was commodities, while others of note included UK and global equity income funds, which tend to favour defensive sectors which pay good dividends, and also targeted absolute return funds. At the other end of the scale, then UK gilts, especially index-linked gilts, were among the worst performers, and in fact, UK index-linked gilts lost an average of 30% in 2022 if you look at unit trust funds. Now, as we know, 2022 was a bad year for most equity markets, but also one of the worst years for bond markets, but on record for bond markets. Now, it's why the typical 60-40, that's bond equity portfolio, 60% equity, 40% bonds, lost between 10 and 12% during the year. Good way of seeing this is if you look at the Vanguard Life Strategy 60% equity fund, which is a bit of a darling of passive investors, that fell 11.22% during 2022. By comparison, my own 50k portfolio, which I run on 80/20 Investor, lost just 5.28% during the year, which I am more than happy with. You can take out a free trial if you want to see what's in that portfolio. But one of the keys to successful investing is actually limiting the size of any drawdowns. And I did that by favouring commodities and alternative assets during 2022 while avoiding bonds and technology stocks. I mean, another interesting parallel between December 2022 and December 2018 is that December 2018 was one of the few times that the 10-month moving average indicator sounded the all clear, as it did at the start of December 2022. I won't go into detail, you can see past shows about that, but it's an indicator that is pretty good for calling market tops and market bottoms. It isn't a guarantee, but it's got a pretty reliable history. But again, it failed on this instance as it did in 2018, and we slumped into the year end. And indeed, the S&P 500 in America fell below its 200-day moving average, which is a negative sign. It just highlights the sudden souring of mood in investment markets into the year end. But January has started positively. Asian equities have been buoyed by China's relaxation of COVID restrictions, but concerns still remain about the country's latest outbreak of the virus. Unlike 2022, where COVID concerns were global in nature, in 2023 they are mostly focused on China at the moment and its subsequent ability to rebound economically to finally emerge from the pandemic shadow. In Europe, positive economic data along with new inflation numbers suggesting that price rises may have peaked in the Eurozone have been helping European equities to outperform in the first few days of 2023. Go grab your phone, go and have a look at the indices, the DAX, for example, and compare with other indices around the world. You'll notice how well they've been performing. The FTSE 100 has also broken above its 7,700 level, which is the highest level in 3 years. So that's something of note. And in addition, at the start of 2023, bond yields have tumbled as a result of an expected fall in inflation and the increasing likelihood of recession. It means that bond funds have surged in value into 2023. It means that markets are now at a critical juncture once again. So can the US stock market in particular break out of its downtrend and recover in 2023? Can bonds do a similar thing and rebound in 2023? Now, investors are always keen to try and predict what will happen during the rest of the year based upon how markets perform in January. And at this time of year, you will often hear the old investment adage, as goes January, so goes the year. In fact, I used a bit of that in the title of this episode as a bit of a sneak as to what would be coming on this video. Now, the interpretation of that adage takes various forms. One version claims that the first 5 days of January statistically influences how the rest of the year will pan out, while another version, known as the January Barometer, claims that positive stock market returns over the whole of January are a strong indicator of positive stock market returns for the rest of the year. While we'll have to wait until February to be able to look at what happened in January as a whole and see what that January Barometer might be suggesting, but after the first 5 trading days of 2023, the S&P 500 closed up 1.3%. So according to the Stock Market Almanac, that bodes well for the rest of 2023 because the last 47 times where we had first 5 days that are up, that's been followed by full year gains 83% of the time. So that has given an average annual gain of 14%. So statistically, that is significant. Even after the terrible December of 2018, the S&P 500 bottomed and rebounded at the start of January. So by the end of 2019, the index finished up over 30%. But if you buy into market seasonality, it's still worth bearing in mind that January often starts with a bang before seasonal weakness sets in as the month progresses. So even if the market does continue to move higher, it's likely that it's still going to be a bumpy ride. Now, before I finish, it's worth watching out for potential catalysts for the market to break higher or indeed lower in the coming days. And that's in the US, where we get inflation data that's published on the 12th of January, which is technically tomorrow as I record this. Now, in recent months, the release of inflation data has marked a pivot point for markets, which led to a surge in equity markets during the day. We got large intraday swings in stock markets, and it did usually dictate the direction of travel until the next Federal Reserve policy meeting, which in 2023 will be the 1st of February, or the next US inflation data release. So setting inflation aside for 1 second, we've got to keep an eye on that, but we've also got to keep an eye on the latest corporate earnings season in the coming weeks, as this also has the ability to dictate the market narrative, especially if we get some shock result. So 2023 has started in a positive note, but we still aren't out of the woods yet, and we haven't seen necessarily, or we can't guarantee that we've seen the back of this bear market just yet. If you've enjoyed that episode, please make sure you hit that like button and subscribe to our channel, because I do these updates every month. And also, please make sure you subscribe to our Sunday podcast.